In this video, we're going to talk about investing in an election year. I'm going to show you 3 charts that are going to change your mind. But before we do, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, Certified Financial Planner, helping you reach your financial goals. So with the stock market rising and the election getting closer, there's a lot of anxiety on how the market is going to continue to perform as we move closer to the election and through the election. So let's take a look at some charts to see what we can learn from history so we can apply it moving forward. And I want to start with the slide that we went over yesterday. So this is slide 0, and this is the Democrats versus the Republicans. So on the left, we could see the Democrats, and it's the makeup of Congress as a total return from history. So if there was a Democratic president and a Democratic Congress, then we got a 14.3% total return over all of those years. If it was a Republican Congress, but a Democratic president, we got 18.5%. If the Congress was split, Democratic president, we got 16%. And on the other side, if it was a Republican president with a Republican-run Congress, then it was 10.7%. Republican president with a Democratic Congress, it was 7.5%. And if it was split, then it was 17.6%. What I pointed out in yesterday's video was, amazingly, all these are positive returns. The reason they're all positive returns is because if you take enough years in stock market history, it performs. The stocks rise over time. But what I didn't point out in yesterday's video was that the Democratic president with a Democratic Congress did not perform better than a Democratic president with a Republican Congress. And the same thing for the Republican presidency. So a Republican president, you would assume that the Republican Congress would perform better, but that's not the case in either scenario. So I guess we need a little debate to get things done. And we know investing is a long-term gain, but we still have to work through the short-term roller coaster in order to get to those long-term gains. So I want to talk a little bit about the worst days in stock market history. Now, the number one worst day in the stock market was October 19th of 1987. And the stock market in the single day went down over 20%. Now I want you to take a minute and think, what is the number 2 worst day in the stock market history? Let me know in the comments down below. You can take your time because we're going to come back to this question in just a minute. So I'm going to go to another slide and then we're going to come back and hopefully have your answer, and go ahead and put it in the comments down below. So before we get into the worst days in the stock market, and I'll tell you why that's really important in just a minute, I want to take a look at what the election years look like. So looking at this chart, we can look from 1928 all the way up to 2016 in each election year and the returns. What jumps out to me right away is the massive amount of positive returns in election years. Of the 23 years here, only 3 of them are negative. 2 for the Democrats and 1 for the Republican. Now, numbers can be funny sometimes depending on how you're looking at them. That first chart that we looked at today, it looked like under a Democratic president, the market performs better. But if we look at this chart, where we're taking that same information on election years and we're adding them all up, a Republican was elected, we got an average return of 15.3%. A Democrat was elected, 7.6%. But the good news is, in all election years, it was 11.28%. And when a Republican was in office and a Republican was either elected or re-elected, the total return for the year averaged 11.9%. And when a Republican was in office and a Democrat was elected, the total return for the year averaged negative 2.6%. So if history does repeat itself and Trump gets reelected, 11.9%. And if Biden takes office, negative 2.6%. Of course, that's just history. We have no idea what it's going to be. So let's go back to what we were talking about before with the worst days in the stock market, because it's really important that you know about these worst days in the stock market, because let's take a look at the chart. The worst day was October 19th, 1987. The one-day return was negative 20.47%. And the 1 year later was up positive 23.19%. And then you see number 2 there in 2008, October 15th, 2008, down 9.03%. 1 year later, up 20.79%. But was that second day really the worst day in the stock market? Let's take a look. What was the worst day in the stock market? We can see here right here on Wikipedia, number 1, 1987. That's what we just went over. But what's number 2? March 16th of this year. So if we go back to our chart, this chart was actually edited to show 3 dates from this year that ranked in the top worst days in stock market history. So that was March 16th, down 11.98%. So of the 15 worst days in the stock market, minus the ones that happened this year, the average was down 8.13%. But then a year later, it was up 22.38%. And then 3 years later, it was up 11.7%. And 10 years, 10.72% on average. And if you're still questioning whether or not you should be in the market, from yesterday's slide, we also talked about missing the best days in the market and what it would do to your portfolio over time. If you stayed the course over a 40-year period, your $10,000 initial investment would be worth $841,000. But if you missed the top 50 days, it would only be $60,000. Now let's take a look at another chart to kind of change the perspective on how you're looking at timing the market. And you might not be able to see everything on this chart because I'm zoomed all the way out, but if we zoom in a little bit, what we can see is the top blue is the positive gains of the market. The bear markets are what's in gold. So if we zoom in to what is approximately 1987, it's this little blip here of a downturn in the market. And even if we fast forward to today, we could still see that downturn in the market. And it's right here, 1.1 months. And you can start to see it recovering again. Now, I'm not telling you that you should be in the market or out of the market. It depends on your particular financial situation. But I hope this information has given you a little different perspective on how to invest and hopefully improve your financial life. If you've enjoyed these charts, if you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.